Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments and subscribers, I greatly appreciate it. This week up, we're going to do a follow-on to our AT&T spinoff, which is going to be Warner Brothers Discovery, the pure-play multimedia online digital content provider. Let's figure out how much cash flow this business makes, and if we bought it today, post-spinoff, how much do we think we can make out in the future if we bought the stock? You ready? Let's get to work. Like we do with all of our stocks here at this channel, we're going to review the new company, Warner Brothers Discovery, with 5 key attributes. Number 1, top line revenue growth. We got to have it. Number 2, EBITDA, enterprise level earnings must be growing. Number 3, strong free cash flow. Number 4, low debt. Number 5, well priced. What is a well priced stock? A well priced stock is a stock whose current price with a conservative long-term forecast will produce above market returns. That's what we want. We want a high probability of outperforming the stock market. So let's take a look at Warner Media. Now what they've done is they have released jointly with AT&T this deck. And in the front part of it is basically the Discovery Warner Media business. Let's go through it and figure out what information we want to hold and what we think is most important. As always, behind me is the breakdown of the transaction itself. So just a quick recap. Discovery shareholders contributed all their assets into a new co. AT&T contributed Warner Media into this new co. AT&T shareholders own 71% of that business. Because it's so huge, it diluted down the original Discovery assets. So this new co here, that's the Warner Brothers Discovery entity. This is what we're going to be reviewing now. They paid AT&T about $43 billion. AT&T gave them debt in a debt and cash combination for Warner Media. Now they've got the Discovery and Warner Media in this business, and this is kind of its own pure play. Everything else is gone. Let's take a look at their financials and figure out what the restated financial of Discovery really is. All right, so this is a little bit of an eye chart, and I apologize, but I want to go through because it's critical that you understand and read the 10Ks that come out post-merger. And what they do a pretty decent job of showing this is the balance sheet December 31st, 2021 for Discovery, now Warner Media Discovery. And what they're saying is here's Discovery's balance sheet, here's Warner Media's business, here's some merger adjustments, and then a final a pro forma for both businesses. And I'll just look through the consolidated business, $5.6 billion of cash on hand. They got basically $154 billion of assets, probably a lot of goodwill. You have $33 billion of goodwill and intangible assets, $61 billion. Intangible assets are all the brand recognition for HBO and some of the content they have. But it is important to know that 61 and 33 is $94 billion of fake assets. I know it's a tough word to say, but I mean, that's basically $100 billion of the 154 because it's all either credit for brand names, paying more for acquisitions historically, kind of carrying value of assets that are hard to monetize if they should ever struggle and go into bankruptcy. We want to make sure the debt load of this business is super low because there's not a lot of assets, physical hard assets backstopping the business itself. But nevertheless, $154 billion. On the liability side, I think they've got total current portion of long-term debt and current portion and non-current portion. So $56 billion of long-term debt and very, very tiny $350 million of current portion. So not actually a whole lot of debt. Let's figure out how it stacks up with earnings. Okay, here's the earnings that they're releasing. Again, this is 12 months of data adjusting December 31st, 2021 for the combination of the two businesses. Here is Discovery, $12 billion of total revenue. Warner Media, $33 billion. So this was a much bigger business already going into Discovery. That's why Discovery reverse merged into that. We don't need to talk about that. But that's why you'll see a lot of dilution, a lot of debt, because they bought a much bigger entity than they were. So consolidated $45.5 billion of top line revenue. On an operating profit line, net operating profit right here. It's tough to see when I'm zooming in like that. A loss of 1.9 billion. Both these entities made money. Looks like there's some merger adjustments that are bringing down the earnings. So that's probably where they're coming from. most of that actually is depreciation here, $3.7 billion. That's going to add, we'll add that back in our EBITDA, and $1.2 billion of kind of some SG&A that cost them during the merger. I'll add that back in our EBITDA as well when we get there. All in all, I want to get the share price, the shares outstanding. This is how they finance the transaction, right? So a small company bought a really, really big company. They used some debt. Again, 54, we covered that. But what they did is they issued a lot of shares. So 664 million shares outstanding, now 1.4 billion shares outstanding. So the massive dilution, but they gained a lot of assets. So they've got to figure out how this shakes out. So this is the one P&L. They gave us 2 more years of this. I'm not going to review the other 2. I'll consolidate them for you. But it's a decent business, although it's cash flow negative right now. Earnings negative. On an EBITDA basis, it's positive. A lot of this is the M&A transactions. The 2 underlying businesses are both profitable on an operating income line basis, so I'm comfortable with the profitability here. Okay, let's take a look at the historical financials for Warner Brothers Discovery. What you're seeing here is the historical numbers when I pull Warner Brothers Discovery and kind of an adjusted number of 2021 based on what I just went through with you. They did not, in fact, release multiple years. I think I said they did when I was on the other sheet. They did not. So the only data I have is this and their forward guidance, which is a whole lot different from what we got from AT&T. What I liked about AT&T is they gave us a lot of detail, 3 years back historical, so I can kind of average what they're going to do. And we liked that about the business. The Discovery, Warner Brothers Discovery people did not release as much information as I would like, and that's a little bit of a concern. But we did see the $45 billion of revenue, and I get $8.5 billion of EBITDA based on some numbers that I ran here. So I took the operating income that you saw earlier, the loss, $1.9 billion. I add the depreciation. I add that SG&A related to the M&A activity, and I get $8.5 billion of EBITDA for the adjusted 2021 period. Now, I'll get to in a second. They're talking $3 billion of synergies that they can find. That gets me to $11.5 billion of EBITDA out long term if they get all the savings that they want for the merger. Then they're saying that they're going to do another $15 billion of direct-to-consumer business that's going to lift and grow their revenue. And I'm having trouble bridging it. The only thing I can do is assuming they've applied a margin to that incremental revenue to get to the target that they said they're going to achieve is $14 billion. And that's a big number. So we're currently at 8.5 of what I can come through as kind of EBITDA that I can find based on the numbers they've released. They're telling me, hey, trust us, I can fire people and do other things to generate another $3 billion of savings. Okay, that's 11.5. And then on top of that, I'm going to grow the direct-to-consumer business and get a margin from that that's going to bring me to $14 billion. So that's a big delta. That's a doubling of earnings of of EBITDA that they're telling us that they can produce out in the future. And I wasn't really able to find it. I would have liked them to really bridge that for me a bit better. I'll cover in a second, but they give a presentation where they say $54 billion is the price target and $14 billion is EBITDA. I'm showing 45 and 8.5. So we're going to have to figure out which number basically do you believe? Do you want to go off historical numbers and say, hey, this is what you've shown me you have? I'll forecast off that. Or do I take your word for it and put my money on the table that it's kind of the gospel, I believe it, it's going to be true? We'll look at both versions see what we get. But let's go through the cash flow and the historical financial, then we'll forecast going forward. So then to bring this home on the revenue piece, what we discovered earlier is that the Discovery business itself is much, much smaller than Warner Media. So you're seeing smaller revenues from Discovery itself, and then boom, the merger happens and it spikes. So the historical numbers are harder to use because it's a whole new business. But historically, they were able to grow the revenue and the earnings. I like that. Debt went from 16 to 16 billion. It's now 56, again, leveraging themselves up to do the deal. They had to borrow a lot, and they had to issue a lot of shares. But I'm giving you some historical context. The old pricing and metrics for Discovery as a pure play, the old EBITDA range it traded in going forward, and some metrics they're now at 6.6, which is kind of high for the leverage of the business itself. They are saying that they're going to bring this down over time, but it is high. I'll give them that. So this is EBITDA. Let's take a look at cash flow. Okay, now we're back to the pure play Discovery cash flows, right? So this is historical data, just Discovery. It does not have Warner Media into it. This is Warner Media that I've adjusted. But I want to take a look and see what they did as a pure play, make sure the business worked, and by and large it did. About $1 to $2 billion of annual cash flow from operation, 1 to 3. Very little CAPEX, mostly because it's probably content related, right? Content companies have very little CAPEX. So this is true. I've zeroed out the debt just to make it a little bit simpler for comparison purposes. Strong free cash flow shares, pretty solid share cash flow per share and a growing number. I like that. Share price and a decent yield. It gets pretty high out in here. I'm not sure if I fully believe that, but in the 7% range is probably fair. If I adjust what the new pro forma cash flow is, and remember they did not release this, the only thing they say is that they expect 60% of the EBITDA to flow through to cash flow. That's what I'm doing here. I take the EBITDA that they gave us, the 8.5. I give 60% of that. I get 5.1 billion of cash flow operations. My complete estimate based on some numbers they've said. Believe me, this is not information that they've released. It's just I'm trying to guess at it because they gave me nothing. CAPEX, I'm just using the average, and I get kind of a historical number of $4.7 billion of cash flow against the new, much, much greater shares outstanding because they had to dilute themselves to raise the cash to go buy Warner because it was a big business. Look at that dilution. And what that did is it cut $1 out of the cash flow from a share for the business. So I think that's kind of interesting that Warner, the Discovery, pure play, felt so boxed in and behind the 8 ball that they had to do a monster deal to try to get it done. And in the end, that monster deal actually is lower on free cash flow per share to the investors post-deal. It went from $3 to $2. That's the effect of the dilution they had to issue with the shares to raise the cash to go get the deal. But now we're gonna go review what they said in their release, figure out what we think the future is going to look like. Then we'll take a look at the value play. Okay, we're back on the deck that they released. It's on their website. Go to WarnerMediaDiscovery.com, their investor relations page. You can download this presentation. It's also on AT&T's webpage. It was a joint release. We covered this already. Let's go through and talk about some of the material that they're going to get. So this is HBO Discovery combined. Nice kind of visual of saying, hey, look at us. All the cool content we're going to hopefully monetize, more content, and this is what I wanted to get to. This is kind of the highlight of what they're trying to do. And they're saying greater scale, $52 billion expected revenue. That's where I get on the sheet, and a $14 billion expected adjusted EBITDA 2023. So that's 2023's number out 2 years, right? EBITDA. And this little hash mark, we're going to go and take a look at that in a second. But one thing that looks like they're doing is they're adding this direct-to-consumer business. This $15 billion gets them from the reported revenue that I can show, $45 billion, up to the 52. I think they're saying, hey, we're going to take this normal business, we're going to tack on an additional direct-to-consumer business with all these new brands, and it'll instantly produce, or in a year, produce an extra $15 billion. Good for them if they can get it. And it's up to us as investors to say, hey, is the price low enough to give us this boost? Is it worth the investment? Do we believe it? Here's your $3 billion of synergies, saying, hey, we're going to fire people and save money. And some other things. And then here they bridge it. They say, hey, this is the delta on a graph, adjusted EBITDA and forward. And then bringing the debt rating down over time. This is why I think I'm going to check the box on debt, because they're promising to delever, and they've got some cash on the balance sheet to do so. I think I'm okay with where they're going to go. Historically, they were below 3%, 3x. Oh, by the way, the reason why I use 3 as a number for debt to EBITDA, not 5, not 10, is because these guys are saying I should be at 3. Why? Because senior lending banks tell companies 3 times. That's why I'm not making a number out of thin air. This is investment banking 101, 3x for senior debt. That's where it needs to be. So I think what we're doing is we're trying to bridge this 12. I'm not quite there, right? And the 14. The next thing I want to show you is you want to read the footnote. If I come all the way down past everything else, I get to this footnote. This is the Time Warner Discovery footnote. And in here, adjusted EBITDA gives you kind of the context. It says, I'll read this because it's hard to read. Adjusted EBITDA estimates depend on future levels of revenue and expenses, which are not reasonably estimable at this time. Accordingly, we are not able to provide a reconciliation between adjusted EBITDA and the most comparable. So what they're saying is, hey, this is a wild-ass guess, and I can't really bridge to the number. And I think that's why when I go through here and try to build up to the number they're reporting, I'm having to guess at both this number, $3 billion, and this billion, $2.4 billion, are guesses on their part. And that footnote, which is buried down below, says, hey, this adjusted EBITDA target, I can't bridge to. It's a number I want to try to achieve. So it's up to you as an investor to say, hey, is the juice worth the squeeze here? Do you believe that the $14 billion is reasonable, or do you go off historical what they've been able to achieve? So let's forecast these businesses and try to figure this out. All right, let's forecast this business. We're going to do it two ways. Number one, I'm going to use the more conservative $8.5 billion of EBITDA that I could come up with. Then we'll scale to the 14. We'll look at the difference in the IRR and we'll judge for ourselves if we want to keep which one we would believe. So $8.5 billion, I'm growing at 3% because they don't really give guidance, and I want to be conservative. They grew the business historically faster than that, but I have very little information, so I'm just going to throw 3% out there. 8.5 becomes $11 billion over this time frame. I apply a 10 times market multiple. It's a higher market multiple than we gave AT&T because A, CAPEX for digital companies are much, much less, and B, they tend to trade higher multiples than the AT&T, the heavy CAPEX industries. So that gives me $110 billion of enterprise value, less the debt that they have on balance sheet. It gives me a $54 billion market cap divided by the 2.4 billion shares outstanding, the much, much larger diluted shares I have outstanding, gives me $22.35 long-term price target based on the conservative EBITDA of $8.5 billion. Now, in their presentation, they said that 60% of EBITDA should be expected to flow through to cash flow from operations. And that's what I'm using here. I'm basically taking the EBITDA times 60%, divide by the shares, and grow that. And I get $2.12 up to $2.74 out 10 years. I then apply a 6% yield, which is a reasonable yield for the stock, and I get $45.73 out long term for a free cash flow valuation for Warner Brothers Discovery. Now, as always, what we do is we look at the two valuation methods. Free cash flow per share, $45, and enterprise market multiple, $22. Looks like the free cash flow per share is actually much higher than the market multiple. Maybe the market multiple is too low, but what we like is we like the cash flow from valuation. That's up. I like to see that. But I'm going to split the difference anyways because I don't know which one's right. I'll use $34 to be conservative. Then I'll look in the stock market to see what I can buy the stock for today. I can buy as much stock as I want for $24 a share. All right, now let's take this and put it into our IRR model. So here we go. Here's the free cash flow per share based on the lower $8.5 billion of EBITDA. I'm buying at 24. I'm selling at 34. I get this debt stream, I get a 14% IRR. That 14% is larger than the S&P 500 has done historically for any 10-year period of time, which is 10%. And it's based on a more conservative forecast that we're using, the 8.5, not the 14 billion. If I put it into a distribution, so we're here, the current forecast has an economic model. Who knows if it's true, right? Nobody knows. $24 a share is current price. If it goes up in price, IRR comes down. If it falls in price, IRR goes up. It gives you a range. You can look back at this video, 6 months and see where it might be. Very, very interesting stock. Let's take a look now at the upside if we were to move to the $14 billion of EBITDA. Okay, here we are for $14 billion of EBITDA. Now, they said this is a long-term price target. I even think they said 2023, but it's close. for $14 billion. Again, that includes $3 billion of synergies and another almost $3 billion of direct-to-consumer business, $15 billion on the top line, plus the margin gives me $3 billion of incremental EBITDA. That's almost a doubling from where they are currently. And it's a big assumption, and it's basically the upside for the business. But if they pull it off, that 14 can grow to 18 over time. I give the same 10% market multiple or 10 times market multiple because the growth rate hasn't changed, it's 3%. Back off the debt, divide by the shares outstanding, I get $51.56. If I do the same thing for free cash flow goes up significantly, and I get a free cash flow value of $75 basically. Put this into the IRR calculation, and I get a 26% IRR upside. Very, very interesting. If I throw this into the distribution curve, it's still a buyer. I'm still a buyer if it goes up, and we believe the 14 billion. So it's up to you if you think that's correct. Let's review the 5 key factors, okay? Number 1, top line revenue growth. We don't really know. It has grown historically, so I'm going to check the box that they can do it because they grew historical discovery. Now they have more content, so I'll check the box. EBITDA is growing. We don't know if it's 8 and growing or 14 and growing, but the EBITDA itself is growing. Strong free cash flow, yes. CAPEX is low relative to cash flow from operations, so I'll check the box. Debt is higher than we would like. They've acknowledged it, and they've said they have a game plan to bring it down to 3 times, which is what we want. I'll check the box. And well priced, yes, I think it's well priced because on a conservative number, I'm getting 14%. On the upside case, I'm getting 26%. That's a very, very strong return. We do not see returns on this channel in the 26% range very often. So I think it's a very interesting play. Post-merger spinoff, when the dust settles, you might find yourself in a very good position had you bought the stock today. So I'm giving it a good based on a cash flow analysis at Rational Investing. Now, if you like this type of analysis, you want to learn to do it, teach yourself, I highly recommend you visit my website, cashflowinvestingpro.com, where I teach you to learn how to read 10Ks. I give you this Excel financial model, and I'll let you build forecast models for your own portfolio. And I highly recommend you take the course. It'll teach you how to create a custom focused portfolio of 20 to 30 stocks that over time should have a higher probability of outperforming the stock market if done correctly. You can also join the Cash Flow Club. In there, in the club, you can download, follow the links below. You can download one-pagers that I upload about a dozen or 15 every single month in like a blog format. Many more than I can cover here at the channel. But it's a way I can communicate some thoughts to some very interesting companies. Check it out, cashflowinvestingpro.com. Sign up for the course or the club, it's up to you. I hope you really like this review of Time Warner and Discovery. Very interesting stock to do, lots of fun. If you like the stock, throw a comment down below. Tell me if you want to buy the stock or not. It's always fun to read the comments. Hit the like button, the subscribe. I really appreciate it if you do. Up is going to pop a couple other videos of value-based investing strategy and reviews that I've done on stocks. Take a look, see what you think. Again, my name is Cameron Stewart. This is Rational Investing. Thank you very much for watching the channel. Don't forget to comment and hit the subscribe button. Thanks very much. Take care. Bye-bye.